When it comes to investing, one of the biggest decisions you'll have to make is whether to choose an ISA or a pension to hold your asset in. This is because either of these accounts will help you grow wealth whilst being protected from tax, but each works differently and has separate tax benefits. So I thought it would be a good idea to go through the pros and cons of each in this video to help your research in what will work better for you in your individual circumstances. So let's firstly take a look at each account and their various subcategories before we take a closer look at each. Firstly, you have 5 types of ISA to choose from if you include junior ISAs. If you want cash savings, maybe for shorter term goals, a cash ISA could be your choice. If saving for a first home, a lifetime ISA comes with a 25% government bonus on anything you deposit up to £4,000 per year. But you are limited in that you can only use it penalty free to help you with that first house purchase or deposit, or once you reach 60. There is an innovative ISA and also a stocks and shares ISA to hold investments. The fifth relates to a junior ISA that allows you to contribute an additional £9,000 each year into an account you open for each child up to the age of 18. When it comes to pensions, there are 3 main types. Workplace pensions. This is where both you and your employer contribute to your pension pot. SIPPs, self-invested pension pots, also known as private pensions, that you have taken out instead of or in addition to your workplace pension. And a state pension that you are entitled to at the age of state retirement age. This is currently 65, but rises to 67 in April 2028. Although not looking at the state pension in this video, it is also worth considering factoring this into your retirement plan. But what the state pension looks like now might be totally different when you retire, so don't be complacent about this. And on the subject of your future retirement plans, remember that this is a financial education video and should not be construed to be financial advice. I'm going to provide basic examples later in this video to demonstrate what you can generally do using ISAs and pensions to be tax efficient when drawing money at retirement. However, retirement planning is one crucial area where a certified financial planner could help you maximise your financial potential in later life, and you might seek the advice of a qualified professional if unsure of anything. So let's look more closely at pensions and their tax benefits. The most significant factor is that if you contribute to a pension, the government provides 20% tax relief on top of your contributions. And depending on the type of pension, this relief could be provided in 2 different ways. If you have a workplace pension, tax is deducted from your remaining gross wages after pension contributions are firstly subtracted, meaning that you get taxed on a smaller gross amount of your wages. This means if you contribute £100 into your workplace pension, it actually only costs you £80. If you have a private pension, or SIPP, the government adds this relief directly to your pension account by topping it up. If you contribute £100 to a private pension, the government will add £25 on top, meaning that £125 is contributed in total. A workplace pension is a retirement savings scheme that is arranged by your employer. Contributions are made by both you and your employer, where the government also contributes 20% tax relief. And workplace pensions generally come in 2 different forms. Defined contribution pensions. This is where the pension pot's value at retirement depends on the amount contributed and the performance of the investments. There is no guaranteed specific benefit. And defined benefit pensions. These are also known as final salary or career average pensions. These provide a guaranteed income in retirement based on your salary and the number of years you've worked for your employer. Defined benefit pensions are now quite rare in the private sector, but are still available in the public sector professions such as emergency services or education. If you've been employed at some stage since 2012 and were over the age of 22 and under state pension age, there is a good chance that you already have a workplace pension, as it is a legal requirement that employers automatically enrol you into a scheme. So unless you decided to opt out of such a scheme, then the chances are you're already invested. You could even be in more than one scheme if you've changed employment since 2012, as you would have been auto-enrolled every time you started a new employment. If you have more than one workplace pension, you can transfer them to join pension accounts together, or you can choose to remain in existing schemes and keep them all separate until you retire. The added benefit of a workplace pension over a personal one is that your employer must contribute a certain percentage of your wage into your pension. Some employers will even better this and contribute more into your pension or even match what you pay in, so it will be worth checking this out. But the minimum, and generally the norm, that the employer must put into your pension is 3% of your qualifying wages. And qualifying wages or qualifying earnings in the 2024 to 25 tax year are anything over the first £6,240 earned. This is the lower earning limit. This 3% is part of a total minimum contribution of 8%, with the employee contributing 5%. So in this example, where an employee earns £30,000 per year, and after the qualifying earnings threshold is deducted to leave £23,760, the employee's total contribution for the year will be £1,188. The employer's contribution at 3% would be £712.80 per year. This is a total annual contribution between employer and employee of £1,900.80. On a monthly basis, this means that the employee contributes £99 and the employer £59.40, £158.40 in total. In this example, the employer contributes over £712 to the employee's pension pot as a minimum, and this will undoubtedly help to boost the retirement savings of the employee when adding their contributions and any tax relief that the government provides. And this will especially be the case if your employer is putting in more than the normal general 3%. Whether 3% or more, this is free money going into your pension pot, and you might want to prioritise getting the maximum you can from your employer. And before I move on, can I ask that if you are finding the content of this video useful and interesting, then please can you consider hitting the like button, subscribing to my channel, and turning on your notifications so that you'll be aware of when I post new content. An alternative to a workplace pension is to open a private one, or a self-invested pension pot, SIPP as they're often known as. And some people choose to open a private pension instead of a workplace pension because they are self-employed or unemployed and do not have access to such a scheme. If unemployed or a non-earner, you can still pay up to £3,600 into a pension per annum. They are already contributing the maximum amount into the workplace pension to obtain the maximum employer contributions, but still want to put more into a pension. And linking this next point to the last point I just mentioned, they want more choice and lower fees from a private pension. If you do already have a workplace pension, then the argument for opting for a private one instead, even if because of those lower fees and more choice, is outweighed, in my opinion, by those employer contributions that you get from that workplace pension that are going to help you build your wealth quicker. There is often, however, in my opinion, a good argument for opening a private pension in addition to your workplace one, because in that case, you would max out your employer contributions by investing what you need to invest in that workplace pension. But if the fees and costs are higher in that scheme, any remaining money you have to save or invest could then be put into a private scheme, where costs might be lower and where you might have more control and choice. I'm not your financial advisor, and I'm not saying that you should do this, but this is definitely something that you need to research when comparing your workplace pension with any private SIPP that you might look to open. With either a workplace pension or a SIPP, the maximum amount that you can pay into it each year is known as the taxable or annual allowance. For the 2024-2025 tax year, that annual allowance is £60,000. This means that depending on how much you earn, you can contribute up to £60,000 per year into the SIPP or workplace pension of your choice and receive that tax relief on your contributions. However, there are a few important points to note. The annual allowance is the lower of either £60,000 or 100% of your relevant UK earnings. So for instance, if you earn £40,000 a year, this is the maximum you can deposit. Secondly, the £60,000 maximum includes tax relief, so the actual maximum you can deposit is £48,000, the other £12,000 being made up of that 20% tax relief. You can carry forward any unused annual allowance from the previous 3 tax years, but you have to firstly max out your current year's allowance, of course. And higher earners, those with an adjusted income over £260,000, may have a reduced annual allowance. This is called the tapered annual allowance. And a final point to make is that you can contribute to a junior SIPP for each child. The maximum you can deposit per year is £3,600. Again, this is actually £2,880 plus the government 20% top up. The downside of paying into a pension is that currently you cannot access your funds without severe penalty until you reach the age of 55, and this age rises to 57 from April 2028. After that, it rises in line with the state pension, always staying 10 years below it. For example, if the state pension age rises to 68, then the pension age will rise to 58. On the plus side, at least you won't be tempted to dip into your savings if you don't have access to them. When making withdrawals from your pot at pensionable age, 25% of anything you withdraw up to a maximum of £268,275, also known as the lump sum allowance, is tax-free. You don't have to take this as a lump sum, and what you decide will depend on your circumstances. An alternative to the lump sum is that you could opt for regular income payments, where 25% of each withdrawal would be free from tax. The remaining 75% still falls to be taxed at whatever your personal rate of income tax is at the time of withdrawal. Currently, in 2024 and 25, the rates are standard personal allowance of £12,570. This is the amount of income you can earn without paying any income tax. Then you have your basic rate threshold, and this is anything between £12,570 to £50,270. And on this you would pay 20% tax. And then you have a higher rate threshold. This is any income above £50,270 up to £125,140. And this is taxed at a higher rate of 40%. If your income exceeds £100,000, your personal allowance is reduced by £1 for every £2 of income above £100,000. And this following example shows how you can be tax efficient in your pension withdrawals. It makes an assumption that you're not receiving any other income other than your pension. As a basic rate taxpayer, you intend to draw £20,000 per year from your pension fund, either monthly or as a lump sum. Firstly, you get 25% tax free, which is £5,000, and £15,000 then remains. You also deduct your standard personal allowance from the remaining £15,000. This leaves you with £2,430. And as a basic rate taxpayer, you'll be taxed at 20% on that remaining £2,430, leaving you with a tax bill of £486. Currently, you do not pay national insurance on pension income, which is another tax bonus. Therefore, in these circumstances, the total you pay in tax on £20,000 income is £486. This is already tax efficient, but I will show you an example later in this video that you might find to be even better. Everything I've mentioned so far generally assumes that you're a basic rate taxpayer, but there are additional benefits for paying into a workplace or private pension if you're an additional rate or higher rate taxpayer. Firstly, you will generally be entitled to more tax relief, up to 45% in total depending on your tax bracket. This additional 20 to 25% above that of a basic rate taxpayer can generally either be claimed back through a self-assessment tax form or by providing your pension statement to HMRC at the end of the relevant tax year. And secondly, paying into a pension could be a way of reducing your tax burden to keep you in a lower tax bracket. If your annual income is £55,000, you're in a higher rate tax band, paying 40% tax on income over £50,270. By contributing £4,730 to your pension, you reduce your taxable income to £50,270, keeping you in the basic rate tax band, as pension contributions are either deducted from your gross wages before taxes apply to the remainder, or you get that relief back from the government to top up your pension. Every time you pay £1 into your pension, you raise your basic rate tax threshold by £1. Remember that this example assumes that you have no other income and that you have no other assets generating things like capital gains, dividends, or interest payments. And these gains could push you into the higher tax bracket. But you could also total this up and take it into account when deciding how much to pay into your private pension to keep you into the basic rate tax threshold. As we mentioned earlier, in the case of a private pension, that additional tax relief you get as a higher or additional rate taxpayer will come from a self-assessment tax return or by providing a statement. This will get paid to you, and it will be then up to you to decide what to do with it. So having looked at some of the great tax efficient benefits that pension provides, let's now move on to ISAs. Whichever ISA account that you choose, anything inside it, be it cash, stocks and shares or other investments, is allowed to go free of any tax, such as the tax on interest, capital gains or dividends. In a financial year 2024 to 25, you have a limit of £20,000 that you can pay across the 4 ISA account types of your choice. For instance, you could pay £4,000 into a cash ISA, £4,000 into a lifetime ISA if you are age qualified. £4,000 is the maximum you can pay into a lifetime ISA per year, and you could pay the remaining £12,000 into a stocks and shares ISA. Remember, you also have an additional £9,000 allowance per child to pay into a junior ISA account you open for each on top of your £20,000 allowance. Apart from a lifetime ISA, which is designed for a first home purchase or maybe as a retirement pot with strict conditions for a withdrawal, ISAs are much more flexible than pensions in that you can withdraw from them at any time and pay no tax or penalties on anything you withdraw, with there not being any restrictions such as a retirement age to impede you. And you have a reasonably large £20,000 allowance to use every year. When looking at the more straightforward cash or stocks and shares ISAs, the downside is that you don't get that 20% uplift from the government on top of what you pay in, and you won't get those additional contributions from your employer as you would with a workplace pension. ISAs also don't affect your tax thresholds, so you won't benefit from these being raised when you pay into them, and your £20,000 allowance per year is lower than what you were allowed to pay into your pension. Although there's probably not that many people maxing out that £20,000 allowance per year in any case, so this is probably a smaller point. But if you do have this problem, you can't use previous year's allowances as there is no carryover. So which one should we choose? Well, let's first calculate what each would accumulate over 30 years when you pay in, say, £100 per month. This assumes you are using a stocks and shares ISA to invest with an annual return of 7%, which is a fair reflection of what the global markets tend to provide on an average annual basis, and that your employer is contributing that minimum 3% of your qualifying wage to the workplace pension, which, for the purpose of keeping things simple by using the earlier example, is £23,760 when basing it on that £30,000 salary. As you can see from the chart, paying into a workplace pension enables you to grow the biggest amount. This obviously comes from the extra employer contributions topping up what you pay in, and that will be bigger if your employer contributes more than that minimum and normal 3%. This total is also enhanced by 20% tax relief, with this tax relief also pushing private pensions up into second place. ISAs come in third due to there being no employer top-up or tax relief, but at least everything you draw from this account is completely tax-free. Remember that in real life, you might decide to contribute more into one than you would into another. So this is just a basic, simple, general example here. And these calculations don't take fees into account either, with those fees for workplace pensions often being bigger than you would find if you opened your own private SIPP or pension. But at least it gives you a flavour of where you might find your better returns over a longer period of time were you to open all three. In reality, you might want to have a mix of all three. If planning for retirement, as already mentioned, you might want to get the maximum you can get from your employer through that workplace pension before using a SIPP and private pension in addition to this to get those lower fees, better choice and more control. You might also want to open an ISA for the added flexibility of being able to withdraw funds at any time, knowing that withdrawals will be free of any tax or penalty, or to complement an income withdrawal strategy. And with that, I want to bring you back to the earlier case study of that basic rate taxpayer wanting to withdraw £20,000 income a year. A way of doing this completely tax-free would be to use a combination of accounts. In the current tax year of 2024 to 25, you can draw £16,760 from your pension pot completely tax-free as a basic rate taxpayer. This takes your personal threshold into account and 25% tax-free of any pension withdrawal that you're entitled to. If you decide to also grow wealth through an ISA, then the remaining £3,240 can come from this account, giving you a tax-free total of £20,000. This example is not necessarily for you to replicate, and your personal circumstances will be different to what I've illustrated here, with a more complex strategy probably being required. And as I mentioned earlier, when planning for retirement, it may be prudent to seek the advice of a suitably qualified professional to go through your financial circumstances and to tailor a plan suitable to your individual needs. Before I finish, I'm going to leave a summary of some of the changes that came out of the October 2024 budget. Thanks once again for watching.